All right. Good morning, everybody. So it continues. We're going to get a little bit of data today on some auctions. Davos is still going on. Some tariff talk. Now we're seeing people like Jamie Dimon suggest that a little bit of inflation is okay when it comes to national security. That's interesting. So it's worth considering what's going to happen as we work through the rest of January into February, and we start to see more signs of inflation coming back and what their responses are going to be and how much inflation is going to be acceptable before it isn't. Small caps are basically flat. The Dow up 0.25%, the S&P at 0.5%, with the NASDAQ really closer to 1%. Generally, we would see those running in line, so either the NASDAQ is going to catch down to the S&P or the S&P is going to catch up with the NASDAQ. At this point, it's a coin toss. We will get some data today. The U.S. leading economic indicators being one of them, but really that's not the bigger one. The bigger one's going to be the 20-year bond auction today at 1 o'clock. And I get it. These auctions are not something that a lot of people focus on. They are something that I focus on, and I hold them in high regard. I watch for them all the time. So when I tell you watch the clock and pay attention to these auctions, it's because I've seen how these auctions can affect the markets. It doesn't happen every time or everybody would start watching them, but they are worth keeping an eye on. And there's a lot of reasons why, especially at the start of this new administration and now with Yellen gone and this Scott Bessent taking his place, that things just can just get messy for a little while before we get a normalized pattern. The wording has to be right. You know, it's sometimes it's just tone. So we'll see. Watch the clock. It'll happen at 1. We've got European central banks chipping their teeth over in Davos. So we'll have Christine Lagarde this morning. We're going to get data out of Japan. And then tomorrow we're going to start getting jobs data. Netflix completely blew it out of the water. And there was some messaging in their earnings, if you haven't caught it yet, where they talked about the difficulty of doing sporting events like the Super Bowl. They're doing really good now. Everybody's flush on the hype and excited. Just, kind of keep that in mind. They are raising their costs, and they had a record number of new subscribers to go with those rising costs, which is another reason the markets pushed them up as high as it did this morning. Just keep in mind, it is in blowout levels, and exuberance can last longer than you ever thought it could. So if you're looking at it thinking, oh, this is a fantastic short, look how far it moved. Well, I don't disagree with you. I wouldn't try to short it just because of how far it moved. That's not good enough yet. Looking at the ES, we're at the call wall. The put wall and the volatility trigger are now close together, and 0 gamma is below all of it, but it is above the 6,000 level. Yeah, that's kind of the saying, right? That it's something like markets can stay irrational longer than you can stay solvent. I think that's the old school popular phrase. Mine's a little more nuanced than that, but yeah, it's about right. You nailed it. All of the options levels that we have are within our own week's range. I don't quite know what to do with that other than to imagine like a Bollinger Band or a squeeze indicator and consider that all of our options levels are now contained within our own week's range. We can explode out of this violently, and I'm not putting a bias on it of bullish or bearish or anything, just pointing it out. We have everything within our own week's range. So we've been keeping track of this lower high, lower low system that we had been developing, and we had this run up, and we were talking about this level here. And the concern was that we were going to hit it and fall down, and that would give us yet another lower high. And that did not happen. So now we take that off the table. And really, we can take this one off the table as well. We need to resolve this, right? If we reject here and fall back down, it's still a complex topping pattern. We need to continue this run. So we can pause like we did back here, just a single candle pause where we don't really fall back too far. We can certainly do that. The line in the sand on, well, how far is too far? I would say 60-50 would be a good line in the sand on how far is too far. We wouldn't want to see it fall back more than 60-50. 60-50 should line us up really well with the high of this bar here. Needs to stay above that. That can give us a candle that looks a bit like this, as long as the next candle after that looks, comparative. Otherwise, if we get one of these bigger red bars and we fall away from this zone, this will be considered, proportionate or an equal high, and that leaves us in a topping pattern. We need to complete this whole thing and get back up into this high. Even if we get trapped up here and we're just stuck in that range digesting, that would be better than falling down and breaking this green line. Now we can wick below this green line. We don't want to close below it, and that's 60-50. So we're looking at today's ADR levels, which I've been comparing my ADR levels with Spot Gamma's one-day expected move levels, and they're really close together when we're looking at the red lines. I've got some more work to do with it, but if you read the founder's note, or you see the picture that I post in the morning that has SPX and ES with two columns, it's got like a dark background. They have other levels, and the other levels is called the SG implied one-day move, and it's usually around 0.67 or 0.61, something like that. I've been monitoring that percent, and it lines up really well with these ADR half levels. So, if you're using Spot Gamma, Mentor Q, Trader Volatility, ADRs, they're all lining up at about the same point. And even if you use an ATR, it still gives you the same levels, comparatively speaking, right? It may be off by a point or two, but we're not trying to define to the tick lines in the sand, just trying to define how far a market should move today if it's still behaving rationally. So don't get hung up on what tool you have. If you don't have Thinkorswim and you don't have this indicator, there's one on TradingView. You don't have that, then you have the Spot Gamma Founders Notes, and you can just run the math and draw a line at 0.6% from the Globex Open or from SPX 930 Open, whichever way you want to go. It still gives you the same information. We're up 0.5% this morning, which puts us closer to the upper edge than the lower edge. The bias would be that we would hit the upper edge first since we're closer to it, but these ranges are really wide. It may not seem really wide because we don't have anything to compare it to. There's not lines from previous days. But the 21-day average daily range is at 1.45 right now. Go back to, say, November, early December, when it was at 1.1, 1.02. It has increased significantly. So volatility is a nerd word for movement. If we have high volatility, markets are making broader and bigger moves on a day-to-day basis. That shouldn't be a surprise if you go out to the daily chart and you see the really big bars that we have out there. All right, if you look at what a normal, typical daily range is compared to the kind of bars that we have now, just really wide, big bars consistently, consecutively. So even if we get all the way back up to the highs, we're still in a dangerous market environment because of these really big bars. Things need to calm down. Until it does, though, run it till it breaks, right? Looking at yesterday's range, if we break to the downside today, we could go all the way down and hit the lower ADR full, and we would still be inside of yesterday's range. At some point, we are going to need a little bit of a reset in the regular trading hours, not during Globex where we had that sort of move. We need a good, decent pullback in the intraday just to kind of stabilize these big advances that we've had. We don't want the market to get into extreme highs where it is almost due to give us a pullback that becomes really violent. So yesterday we had a little bit of a pullback. Wasn't much, but it was better than nothing. I would say don't be surprised if you see 60.50 today. That'd be the lower ADR, and it lines up really low with the RTH low of yesterday. But it's likely that we would do that after we hit the upper edge. So, the phrase of if we hit the ADR early enough in the day, we can go to the other one by the end of the day. Well, that fits today. Thing is, I would like to have already hit it. And the fact that we've kind of stalled out here and failed to get higher than this 60.11 cog line area, we're just kind of stuck here, implies that maybe we won't get up there anyways. So we'll see if we can get some news out of Davos that can go ahead and just push us the rest of the way up and then get that reset. Something akin to that, right? One last little push and then, kind of fade it out, because this is what we're looking for next. But to get that, I think we need a little bit of this. We are back above all the major moving averages. 3, 10, 20, 50, 200 on the daily. We're above all of it. Same with the weekly. Looking at the floor pivots for the day, we have an MDP today. It won't count until tomorrow, but so far today we have it, and it's just above the 60-50. So if we are going to go hit yesterday's RTH low and that lower ADR, we would have to get through the floor pivot first, and the channel edge lines up really good with yesterday's low. Markets hit that line about 80% of the time. So, you could say it another way and say we have an 80% chance of hitting that line today. It doesn't owe us that, right? It's just statistically, that's what we do. The line today is higher than yesterday. That's considered a bullish bias. Price opened above the line. That also is considered bullish, and we haven't hit the line yet. There is a concern about how far away from the line we are, especially when it comes to how far from the weekly line we are. The weekly floor pivot is a bit like the mean when we think about, markets outrunning itself. We don't want to see it get too far away. Now, I've done measures on this, and it can go 4% or even 6% away from this line before it gets, quote, too far away and starts to fall back. Generally, it'll go farther away on the downside than the upside. So if we just use last week for an example, I mean, we didn't really get very far, but just kind of look at that topping pattern where we turned around and started coming back at it. But this was a very small distance from the week, not much at all. If you are worried about how far from the weekly pivot we are, there's SNR levels that you can add or turn on, because these are just basic floor pivots. I'm not going to turn on the weekly one, but if we turn on today's SNR on the daily, we can see 60-25 up here as the S level and R level. So we got support down here at 60.26 and resistance at 61.25. That's almost a 100-point difference right there, just between the S and R1. At this point, this week's profile isn't offering us very much. We have a classic D shape, had a classic D shape. Then we broke it with this kind of a new distribution zone. So I wouldn't be surprised at all if we get another one here. And it's just going to be one of those weeks where we've got multiple distributions, say a lot like what we had back here, where it was just a lot of chunks with expansion. And the point of control was a long ways off. It wasn't offering any insight, kind of what we got so far this week. If we look at previous week's profiles, the only one that may offer some insight is 60.32, all the way back here during that FOMC week. And speaking of the FOMC week, the FOMC day, there is still the gap that needs closed. It's the liquidity gap. I have it marked on SPY for an example, or maybe it's the SPX that I have marked. I have 60.31. That was when the liquidity gap was developed on 12/18 from FOMC. So we're nearing that. If we stay gapped up in the ES, the SPX may open above that and then fade down into it and tag it. Otherwise, if we do open, comparative with yesterday and we start to rally, just keep in mind that's overhead. Where is it at for the SPY and for the ES? Well, that's something you're going to want to be able to answer. This is the day that we're talking about, 12/18. And on this time frame, we can't really see when the 2 o'clock FOMC gap was built. But we can see the point of control for that week, 60.32. 10-day, 30-minute volume profile with TPO, we still don't have alignment between these two. And we're not expecting the point of control to move from its current location anytime soon. So it's likely that the TPO will come up to the volume profile, and we have to just wait it out to see where the new level is going to be, whether we hold up here and eventually move it up here in another week or two, or if we drop back down into these previous levels and reaffirm the spot that it is in right now. It is underneath this, so we have that going for us, and it's not way down at the bottom, so we haven't outrun it. We took out a VPOC from December 26th. We hit that in the overnight hours, so we're just going to use that line now. And we got a new VPOC from yesterday. Pretty close. That'll work. So if we do fade down, then we do have that underneath as a VPOC 60.82. Otherwise, if we keep going to the upside, 60.30, 61.37 and 61.52 are still overhead. It really looks like that liquidity gap started at 61.35 on the ES. So that VPOC, it's only 2 points away. It's good enough. I wouldn't haggle over it. I have a little discrepancy this morning between how much volume we had in green versus trades in blue. A lot more trades down here. A lot more volume up here. All right, so we're looking at the distance from the 10-day. And while we're not overbought yet, we're starting to get to that point where we need to be a little concerned about it. How far away we are from the 10-day is a big deal, right? The 10-day acts a lot like the mean. If we get too far away from it, we end up flipping around and coming back to it. That we need some form of correction if we get too far away. Now, corrections can be that we flip over and go back, but it can also be that we just pause and go sideways, and we give that 10 time to come to us. Either way, it's a correction. We're not there yet. The idea of looking to see if we're in corrective territory. Not yet. But we're getting to the point where we need to be concerned about it. Anything above that 1.25, certainly once we get above 1.5, and we're at 1.7% above the 10-day. You can see that when we do spike up into that level, it doesn't usually last very long. So there's been periods of time where we did, say back in August, after the VIX spike and the carry trade unwind, when we were coming back out of that mess, we outran the 10 and held it for a while. But if you look at what price did once we got above the 10 and we ran to that extreme, price just stalled out. and waited for that 10 to catch up with us. We didn't continue to outrun the 10. We just sat there waiting on it. That's the concern that I have right now. We've got that same sort of run in candles that we can just get back up to the top of the run and stall out like we did here or like we did here. Kind of get the idea, right? That we could just stall out around this 61.30 area and put in a week and a half of just going sideways. I guess that's better than the alternative, which would be to flip over and run back towards the 10 to get a faster reset. We are at the edge of the weekly expected move, by the way. This is how far we were supposed to travel for the entire week. We did it in a day and a half. Now, technically, we close inside this range 80% of the time. We're expected to close inside the range at least 70% of the time. So the odds are that we would end the week inside this box. But it's been a pretty bullish, exuberant week. So, you know, in those scenarios, I wouldn't lean on statistics, which are based on a market behaving normally. If we're behaving irrationally or, you know, getting outside influence, you want to set statistics aside during those events. We're 2% above the 10-week. That's a really good spot to be. On the bigger time frame, like the weekly, we're not overbought. We're not overextended. We haven't moved too far too fast, and it does not owe us any sharp pullback or mean reversion. Not on this time frame. So we're good. We can get another 1%, maybe even 1.25% before we would be back into our normal range. Somewhere around that 3.25 zone. That's a good spot to be. So we're just on the swing back up. Much like this is a swing back up from the lows or this area here. We're just bringing it back up again. So looking at things that are down this morning, China's down, Bitcoin, nat gas, and the VIX. Looking at things that are up, the Mag 7, uranium, semiconductors, value, communications, technology. These are the sectors that you would want to see if you're looking for a bullish day or, you know, a good bullish rip in the S&P and the NASDAQ. These are exactly the sectors that you would want to see. Communications and tech, consumer discretionary, semiconductors, those are the ones. And we've got them. The concern is that they'll make their move or most of their move before the market even opens, and then we don't have any juice left to continue the run beyond that without getting into extremes. We also have gold and gold miners up this morning. Airlines from some earnings news. On a day like this, it's worth watching to see if we start to develop a high correlation coefficient. The idea behind this is the advancing minus the declining issues. And you can do this different ways, but on Thinkorswim, they have these index watch tabs, and you can choose any index. You can just make your own, right? Build a watch list and stick it in here if you want to. But they have ones that are already made, like the S&P 100 or the NASDAQ 100. And with these, it's not just an advanced decline line, it also has the capital in there. How much money is either going in on advancing or leaving the market with declining. Issues are companies. If it's the NASDAQ 100, then there's 100 names here. We can see those 101 names down here because Google's twice. So if you have 95, 97, 98 names all going up, that's a high correlation coefficient. The idea behind it, if 98% of the entire NASDAQ is all going up, then you could trade like an algo, right? What do the algos do? They trade in a basket of stocks. You would want to define what your basket would be, but in a high correlated market like that, rather than trying to be a stock picker to pick each individual things that may be good, picking one or two products, pick 30, pick 20. Already have a plan in place on which ones to buy calls on. And if you can, buy calls on all of them. All 97, 98, 99 names. When we get these sort of events, last year we had 3 good ones. In the whole year, we had 3 good ones. They don't come around very often. I run what I call the alpha protocol during that. And I don't buy all 98 names. My list is like 30-something names. But even in my list, you buy the 30, that's 30 different markets that you bought. Whichever one starts to underperform, you just cut that trade, let the others run. If you don't have something put together for that, it's worth considering what do you do on those high correlation coefficient days, on those days when 99% of the S&P and the NASDAQ and the Dow are all just doing the same thing, up or down. We don't have all the sectors today, right? We're missing quite a few, like we don't have Bitcoin with us. So there'd be a lot of Bitcoin companies that would be less than ideal. And when we say Bitcoin, PayPal gets lumped in there. NVIDIA gets lumped in there. Now, NVIDIA is doing good this morning, even though Bitcoin isn't. But it's just worth considering the idea that, you know, crypto or Bitcoin is not just Riot and Coin and Mara and Hood. It's also other companies that you wouldn't think of at first glance as you know, crypto. AMD, NVIDIA, PayPal. I don't know about you, but those aren't the names that come to mind, right, when I think Bitcoin. And then energy isn't playing ball this morning. So we don't have nat gas, the energy exploration. We don't necessarily need them, but if you're looking for that high correlation, you want everything running. Everything. Keep your eye on the news. Make sure that we don't get any sort of turnaround on that 20-year this afternoon. That can certainly be a game changer. And then tomorrow we got the 10-year. So it's going to be back to back. We're getting closer to the next event. Job numbers, and then the rate decision out of Japan. That's tomorrow night. It's very likely going to be a big deal. So know what you own and be thinking about how to hedge whatever you have, because this rate decision, it can be a big deal. The best case scenario is that they say, no, we're not going to raise rates and we have no intentions of raising rates anytime soon. That'll either hold us sideways or we'll go higher from there, no problem. But if they give any hint or wink that they're going to raise rates, or if they just straight up do raise rates, yeah, we're going down. It's simple enough, right? So I got for you guys. Be careful, be safe. I'll see y'all tomorrow.